Welcome back. Now we are in the next session of the course Introduction to Commercial Banking and FinTech. In this particular course, we are trying to understand the monetary policy and how it is directly impacting the banking operations and where it is useful. And I am sure all of you are able to have the understanding about how monetary policy is critical for the banking sector. To start with this session, as we mentioned in the last session that banking sector is regulated by RBI, right, and RBI has certain instruments. So, one is the repo, then another is the reverse repo, then here we have the quantity base, CRR, SLR, then here we have the what marginal standing facility, MSF. Then here we have the standing deposit facility, SDF. Now, if you try to see that given these instruments, what is the lowest yielding instrument? So, which instrument offers the lowest yield? So, in that case, this is the floor that we are talking about, and it is the reverse repo and SDF. SDF is always lower than the, because it is uncollateralized. So, this is not collateralized, this is uncollateralized. And here we have the ceiling, right. So, marginal standing facility is this. So, here we have the floor which is about the repo, and here we have the repo which is going towards this ceiling, and in ceiling here we have the marginal standing facility. Why it is on ceiling side? Because marginal standing facility is normally a repo plus 1%. So, if the repo is suppose 5%, so marginal standing facility will be 6%. So, this is special window created for the banks to borrow money from the RBI at a higher rate than the repo rate. So, these are the instruments, and here we know that if banks are having excess liquidity, so they can park the excess liquidity. If they have excess liquidity, so then they can park this excess liquidity with RBI and they will be getting the rate of interest. So, rate of interest will be lower than, so it will be lower than the reverse repo. So, because reverse repo requires collateral of government securities, here you do not have any collateral. So, ceiling basically I have tried to show that which instrument is offering the lowest yield for the banks, and which instrument is the most costliest, the floor. The ceiling. So, ceiling and floor, this is what we are mentioning here. Now, the second aspect is, so this is what we are saying, that at the center here we have the repo rate. So, in this case this is what here we have the repo rate. So, repo is the policy rate, and you can say this side we are going towards the floor and this side we are going towards the ceiling. So, this is what we are trying to mention here, that we are talking about. So, here we have the policy rate. So, this is what we are trying to see. So, now most of the instrument that we talk about, the call money or any that I will be talking about. So, call money is the rate at which the banks will have the, so interbank borrowing and lending takes place through call money rate, right. So, this is what here we have. Then there are, so what is the main role? The main role is that it tries to maintain the liquidity in the banking system, and this is what we say, right, and it is mostly happening through the repo operations, right. So, this is what we call it as the, and what is the most important part, that if the repo is increasing, then borrowing and lending in the interbank or all other institutions, for example, there are instruments like call money rate, which deals about the interbank borrowing and lending, right. And second, here we have, So, call money rate, and then here we have the another is the MIBOR, which is the Mumbai Interbank Offered Rate. Interbank Offered Rate. So, this we call it as the MIBOR, and MIBOR is again. So, the moment we have the repo rate going up, it impacts all these rates which are synthetic rates available in the market for borrowing and lending, even the prime lending rate of the bank. When you go to the bank to borrow money, if the RBI increase the rate of interest, banks will also increase. So, transmission channel is that the repo becomes the most important signal. So, as we mentioned about MV is equal to PV. So, if you have repo increasing, money supply coming down, and it implies that we are also targeting the price lower. So, this is the transmission path we have. Transmission here we say that we are talking about something called monetary policy transmission, which means that if what is the path of transmission, whether it is smooth, which means that if you have 1% rate of interest increase, then is it increasing, banks are also increasing by 1%, or it is they are just increasing by 0.5%. If they are increasing by 1%, means that the pass through is very smooth. If they are increasing, suppose if there is RBI increasing the repo rate by 1%, but banks on deposits, because lending they may be increasing, because once you borrow money from the bank, then the rate of interest will shoot up. But on deposits, if you are depositing money with the bank, then deposit they will be passing on just 0.5%, which means that 0.5% they are keeping in pocket, right. So, this is what we are implying. So, if the bank is if the central bank is increasing repo rate by 1%, if banks are also passing on the deposits increasing by 1%, then it is called the 100% pass through. Otherwise, it will be less than 50% or 40%. In case of India, RBI often argues that whatever benefit that they provide to the individuals through the increase or decrease in rate of interest, it does not go directly to the individuals, rather banks have the manipulations in between. So, this is where the monetary policy transmission path is very important to understand. Another crucial aspect is understanding the you can say overall the bearing on the macroeconomy. So, if the rate of interest is higher, so on the borrowing side they may be increasing. So, cost of borrowing has gone up. As a result, most of the things you see that price will be stabilizing, because people have less money to borrow and they will be postponing their investment later, and as a result we see stabilization in the. Now, here you see that so when the repo rate goes up, you will find that bond yield will also go up and bank lending rate will also go up. So, bond yield how it will go up, because the earlier bonds will be getting retired and new bond issue will be in big demand. As a result, so overall the bond yield will go up. So, this is where it is important. And once the demand for previous bond has come down, so price of those bonds will be falling, and as a result your yield will go up. So, this is also one of the explanation that we often attach with this. And as a result, what we see that with some impulse response lag, we measure through the impulse response. So, those who want to explore further on this impulse response function, those who want, if you are enthusiast of monetary economics, then you can read about some of the method that we use for measurement, which is called vector autoregression. So, VAR model. Then in VAR model, so what is the purpose here? We are trying to read the, suppose IIT, the interest rate, how it is being determined by the inflation, exchange rate, or suppose US interest rate and some other variable, right, export for example. So, this we can put in a multivariate system and try to estimate and try to see with the, once we extract the residuals of this, then we try to plot that against one variable to another, and that we call it as the impulse response function. So, it goes like this, that how with 1 standard deviation plus minus 1 standard deviation shock, how it is moving over a period of time, whether it is going up or down. So, that we measure, and this is one area where you can always try to look at. So, Sims got Nobel Prize for this, and he has been credited with this particular regression, but this is sensitive to number of lakhs and other criteria that you can always refer. So, this we call it as part of what we call it as the time series econometrics. So, at a slightly advanced level, if you want to understand the monetary policy dynamics, then you can search on monetary policy. On internet, you just search on monetary policy plus VAR. So, if you search on internet monetary policy plus VAR, then you will get a lot of papers to read and you can easily understand. So, let me summarize that what we are trying to understand here is that we have a different tools, but the ultimate objective is that to maintain the liquidity. So, as we are saying that as the repo rate is going up, the short term money market rates go up and bond yields and the bank lending also go up, and this makes the credit costlier, and as a result the inflation we are able to control, which is one of the important objectives of the central bank. Now, let us go to the next. So, here we have a standing deposit facility. So, what is SDF? SDF was introduced in April 2022 and it acts as a floor of the LAF. So, this is what here we have. So, RBI is standing, it is uncollateralized facility to absorb surplus liquidity. So, it was felt post demonetization that banks were having excess liquidity and they were not able to pump through loans and other things. So, you must be knowing that for bank, the amount of money that you deposit in the bank, so deposit is called liability for the bank. So, this is the liability. So, this you can say it is a liability for the bank. And once we say it is called loan. So, bank gives loan, loan is the asset because bank earn rate of interest on this. So, deposit that here we have, which is a liability. So, you will find that once the banks are filled with cash, everyone is depositing money, they are liable to pay rate of interest on those deposits. So, they must be having some avenues where they can generate some rate of interest so that they can pass on to individuals, right, those who are depositing in the bank. If loan is not, if loan market is not working well, which means that whatever cash they are receiving. So, I had given you the example of rupees 100 that you are depositing in the bank after keeping this CRR and plus SLR. Suppose it is coming out to be 20. So, banks are having now 100 minus 20, 80 rupees. If they are able to lend this 80 rupees to individuals, very good for bank because now it will be 1 plus R into 80 and so on, whatever number of period that they are considering, and it will go on, and then they will be deducting the amount. So, there will be rate of earning on that in the first period, but then it gets reduced because it is a loan. So, principal amount will also come down and rate of interest will be applicable on those principal amounts. But if it is a situation in which the RBI banks feel that they are not able to loan this 80 rupees, then they need some avenue where they can park this money. So, when RBI felt that the reverse repo channel is not absorbing the excess liquidity or whatever is the liquidity available in the system. So, they created this special window, which is the standing deposit facility. So, this is what here it doesn't require any collateral and it is overnight by design. In the same way, it operates like what we call it as the reverse repo, right, and it is the lowest rate. So, what is that? So, corridor. So, SDF is, suppose you can see that repo rate is 6.5%, SDF is 6.25% and margin standing facility is 6.75%, which means that it is above repo by 1.25%, right. Now, if banks have the 2000 crore rupees of surplus, so this is what we have given the example, then it can park overnight as 6.25% with the RBI with no collateral, and rest of the amount they can go through the variable reverse repo rate operation. We call it as VRRR, right, and on whatever is the bid rate. So, in VRRR what we are going to see, in VRRR we are going to see that RBI will accept the bidding at the lowest. So, the lowest will get the first preference because RBI has to pay the rate of interest. So, the lowest bidding will be easier for RBI, so it will be accepted. So, the idea behind this is that SDF gives the floor and it is the fixed rate, the lowest rate it offers, but one of the important advantage is that it does not have any collateral, and VRRR is auction and collateralized. So, this is what we often mention, right. So, this is what here we. So, let me shed light on what we call it as the liquidity adjustment facility. So, what is the liquidity adjustment facility? So, it is the overnight, this is what we are seeing, that it is the overnight. So, we go for the fixed rate repo, and this is the. So, on this banks are borrowing money, it means that banks are going to have the cash. So, this is called liquidity injection. So, we call it as the liquidity injection, right. And SDF or reverse repo is the absorption, which means that we want to call it as the liquidity absorption, right. Right. So, this is what we get. Variable rate repo is this, right. So, this is what we get, and there are term operations like up to typically 7 to 14 days. So, this is what is the term that we use, and in this case it will be through auctioning. So, this is what here we have. So, it happens through auctioning. So, banks, so RBI will come up with, they want to auction 50,000 crore under reverse repo. So, banks will be bidding. So, lowest bid will get the first preference, and so on, and if the 50,000 crore is suppose there are A, B, C, D 4 banks, that will be giving the example in next few slides, and there the lowest bidder will be getting. In reverse, in repo the highest bidder will be getting, but here you have a one challenge for RBI, that it may happen that before bidding banks may have the cartel, that less, if RBI is asking for bidding, then let's bid the lowest, but we will be bidding in this manner so that everyone gets the benefit. So, that is one aspect that could be because of the auctioning plan, and lot of time there are studies talking about such type of cartels where banks are have the understanding among themselves that what rate they have to quote, so that they can reap out the maximum benefit. So, this is where it is having, but overnight is about the repo SDF. So, I hope by this time you have clarity that repo is by SDF and reverse repo, and term operation is by variable rate repo and variable rate reverse repo. So, VRRR and VRRR, and here mostly are through the scheduled banks, right. And then here we have the GSECs and SDLs with haircuts, which means that some adjustment will be there, and this is what we often find, right. So, this is, so let us have the example of VRRR. So, here we are going to talk about the variable reverse repo rate auction, and here in this case what is the plan? Plan is that RBI is auctioning for 7-day VRRR, and auction amount is 50,000. So, this has to be noted. Now, you can see there are 4 banks participating. So, for example, here we have the A, you can say Axis Bank, B, you can say Bank of Baroda, C, you can say ICICI or Central Bank of India, or D, you can say IDBI. So, 4 banks are bidding. The first bank quotes 10,000 crore rupees, right, rupees crore you can say. So, 10,000 crore rupees bank bids, and it quotes the bidding rate at 6.40. Now, second bank is bidding for 15,000 crore and it is quoting at 6.45, and remember here we are talking about reverse repo, right, VRRR. Now, you can, here you can see bank C is quoting as 6.50 and 6.55. Now, based on these bidding, what is the most likely? That since the bidding amount is 50,000, so we can see that A will be getting 10,000 easily, plus B will be getting 15,000, So, B will be getting 15,000 easily, right. So, here we are. So, 10,000. So, 10,000 here we have, second bank is quoting 15,000, third bank is quoting 20,000. So, how much we have? 15, 10, 25. So, 45,000 crore rupees has been exhausted already, right. So, rupees 45,000 crore has been exhausted by 3 banks. Now, bank 4 which is quoting at 6.55%, it will get only 5,000 crore because it is reverse repo. So, RBI will first give preference to the lowest rate quoted by the bank, lowest quote. Then after that and highest quote get the lowest amount, and this is where the cartel formation is possible, that bank D can collaborate with bank B or bank C to get maximum amount of money. So, this is very, so the cutoff rate for this is the 6.55, which is the highest, and you can see the weighted average of this if you multiply with the exposure, that amount that they are having. So, 10,000 into 6.40 that here we have, and 15,000 into 6.45 plus 20,000 into 6.50 plus 5,000 into 6.55 upon 50,000. So, it is coming out to be 6.47%. So, this is what here we have. So, this is what we are getting, the weighted average rate for this VRRR, but banks, the 10,000 crore demand of keeping money with the RBI for bank A will be accepted because it is quoting the lowest, then it will be accepted 15,000, then it is quoting 6.45, and third will be 20,000, then it is quoting 6.50. So, this is what we often mention. Then here we have the VRR auction. So, RBI announces 75,000 crore VRR, and in this case it will be opposite, reverse situation will be following. So, what is the reverse situation? Reverse situation is when RBI is announcing 75,000 crore. So, it will be since it is repo. So, RBI is going to make money out of it. So, banks will be paying RBI rate of interest, right. So, rate of interest RBI is getting. So, what is the case here? That in VRR the bank will be quoting. So, here you have the 6.55, right. So, in this case you can say 75,000. So, bank A, so W will be getting 20,000, then it will be the 30,000 by this, and then 25,000 crore by this. So, how much we are going to see? So, 50 and 25. So, 75 it is already done, right. So, till ZZ is the total allotment that the RBI is going to give, right, but the maximum bidding is done by this bank. So, this bank will be also included, and overall what comes out, that the weighted average rate that here we have 6.61, right. 6.61, above this will be counted the first. So, for example, this will be, these two will be cleared easily, then after then this. The lowest bid is by the 6.55%, it will get the, it will get nothing, and it will be just with the amount. So, here you can see that in case of VRR it is just the opposite of that, because bank will be getting the excess money out of it, right, and here it is in terms of rupees crore. So, this we have to keep in mind. Now, the second is about the quantity tool, which is about the CRR, cash reserve ratio, and SLR. As I mentioned that if you are depositing money with the bank of rupees 100, and suppose RBI mentions that 5% of that amount has to be kept in cash form, not in any other gold or any government securities, then 5 rupees will be in the form of cash if it is 5%. So, fraction of net deposit and time liabilities, NDTL, which is the total worth of the bank. So, when we talk about fraction, so this is what I told in the beginning, that whatever banking that we are doing, it is nothing but we call it as the fractional banking, right. So, fraction of net demand and time liabilities are being paid. No interest is paid on that balance. So, this is what, and the formula of this is delta reserve is NDTL multiplied by the CRR, percentage CRR that we are going to have. If CRR is going to increase, bank lendable resources come down. So, as I told that if bank has to, if the CRR is 5% and you deposit money in the bank, so if NDTL of the bank is rupees 100, right, then 5 rupees it will be CRR, which means that bank can now lend 95 if there are no SLR. And if the bank, central bank increases this, then overall money multiplier effect that we have seen earlier, money multiplier effect will be lower. If it is if it goes to suppose 10%, now bank will have to keep, bank will have only 90 to lend, and this is where it controls the or tightens the liquidity. Then second instrument is about the statutory liquidity ratio, which is the fraction of NDTL to be held in approved liquid assets. So, this is what we often say, and mainly G6 that here we have, and the effect is that as the SLR goes up, more funds are locked in G6 or any valuable asset. So, one of the important aspects of why banks are allowed to invest in government securities, because it automatically becomes the part of their statutory liquidity requirement, SLR requirement, and this helps the banks in later periods to deal with any kind of liquidity shortage. But these are all money supply related tools. So, they all help RBI in controlling the money supply. This is what I want to say. Right, this is what we have, right. So, this is what we plan. So, OMO is this. So, another important aspect that we have. So, maybe in the next session we will be talking about this particular part, the open market operation and the operation twist. But till here I hope you have been able to understand that what is the quantity tool that we mentioned, and it is directly linked with what we have been discussing about the MV is equal to PV, or you can say MV is equal to T, and T is nothing but the value of transaction. Right. So, MV is equal to PT or PV is often considered as one of the important instruments to understand the impact. Let me help you understand with the commercial banking side, because this course is about commercial banking. In case of commercial banking, you will be happy to know that these instruments decide the fate of the banking sector. If RBI is going to really, so during 1970s era, cash reserve ratio was the major policy rate, and repo rate was not there. It came after Narasimhan committee report. So, Narasimhan committee report in 1998, and so it recommended post liberalization period. You can say there were 2 times the committee was formed, 1991 and later. Now, you will be surprised that at that time 1970s era, cash reserve ratio was the major policy instrument, because government wanted money for investment, and majority of these banks had the excess liquidity. So, cash reserve ratio was the major, so it was kept high, almost 12%, 13%, so that banks can keep extra cash in the form of the cash reserve ratio, required reserves, and that money they used to have for policy decisions. So, with this I am stopping it here. Thank you so much for your attention. I really appreciate.